You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
We've reached the final session on our agenda, and this is one we hope will help bring all of our discussions into focus. For this last session, we'll ask the question, what's next for options? It's been a volatile year with new customers, new technologies, and new innovations, all with the pandemic as a backdrop. Now, Lori hinted in this in the last session, so let's take a look into the future as the head of market structure for the Chicago Trading Company, Steve Crutchfield, and his panel break out their crystal balls and let us know what to expect next. Steve?
Thanks very much. I'm live. Okay, great. Sorry, I didn't know I was live. Awesome. It's great to be here. Thank you very much for the opportunity to moderate this panel. I'm excited to introduce my panelists. I've got joining me today to talk about market structure and what the future might hold for us after an extraordinary year in the business. I have David Cross, Managing Director with Dash Financial, Eric Swanson, CEO with Simplex Investments, and Pat Zielinski, Senior Vice President with Box. Thank you, everyone, for joining me today, and looking forward to diving into a great conversation. So let's kick off. Henry, first of all, just building on the intro a little bit and hyping up the panel, Henry Schwartz announced his panel yesterday morning as legends in the options industry, I guess was the phrase that was being used. So I think I could do the same thing, right? You guys are legends? Legends. All right.
We'll go with that.
So
I like it.
Why not? Who's going to disagree? So
Right.
this is an awesome group. We had a great pre-conference discussion. As I sort of alluded to a second ago, just another perfectly normal year in the options industry, record volumes, extraordinary volatility, sort of just one more data point in the collection of things that are a little weird. The OIC note asking folks to dress accordingly for panels. I think it said button-down shirt, jacket, no tie, and sweatpants. Normal pants were not okay, I guess, this year, at least as far as anybody knows. So, but yeah, it's a strange year. We had a pandemic, a jobs crisis, a hotly contested election, all, of course, unsurprisingly accompanied by unprecedented market action, flurries of halts. Remember the continual market-wide circuit breakers tripping right on the open in the spring of 2020 on multiple occasions, and of course the volatility that accompanied all that, and all of it again bringing record volume. So market action cooling off at least a little bit. It seems like on the trading side over the course of the last maybe month or so, we've had a little bit of a seasonal shift. But volumes of course have remained very elevated, and we've had asset prices continue to rocket to new highs. Just an amazing change of events from where we were sitting in as an industry in 2019. So, David, let's start with you. Weird times, extreme numbers. Are we in a new normal? is mean reversion inevitable? What does that look like if so, and what are the ramifications of your forecast and all this for our businesses?
Yeah, sure. Thanks again to everybody for putting the panel together. Looking forward to this. Steve, I think we absolutely are, yes, in a new normal. I think it's for a number of different reasons. Look, we've talked about it quite a bit. There's a whole new generation and demographic, in the investing and trading community that are now more than ever more active, engaged in trading U.S. listed options. Again, for a number of different reasons that we've talked about over the last 2 days. Better technology, significant focus on educational efforts. Obviously, the free commission model plays a heavy role in it. And like you just alluded to, heightened equity prices, which, provide users the opportunity to leverage options with less, capital outlay. The retail presence is absolutely real. That being said, we also think that there's a number of, additional participants that have become more comfortable and, frequent users of listed options. Obviously, Q1 was off to a significant start. I think ADVs were just under 42 million on a daily basis. So definitely seen fall through from 2020, which was a fantastic year. And, like we just talked about, are we going to continue to move forward, or is there going to be some, mean reversion? And definitely we're starting to see that a little bit in April. I think April ADVs are just, about 33.5 million. So off about 16% of the explosive volumes we saw in Q1, but heightened for sure. So, look, I think the genie is out of the bottle, as we say. There's certain, additional micro factors that could have an impact on where we go from here for sure. So whether it's, do we continue to see, realized volatility? Obviously, things have come in significantly from what we've seen over the last 18 months. That's definitely going to have an, impact. We track fairly closely, intraday, ranges in VIX. That has a very direct correlation to options volumes for sure. Do we see a new change in institutional behavior, where, short positioning and behavior has changed with, more usage of listed options? That can no doubt play a significant role. And no doubt there's a handful of additional items that could damper, volumes on a going forward basis. Return to normalcy, which would be a nice thing, not sitting behind a computer for 12 hours a day. Sporting events, people getting back out. That could have an impact on the retail trade, for sure. So, do we think we're going to see heightened volatilities and, volumes more specifically going forward? Yeah, I think it's definitely possible. Even on lower volume days, we're still seeing, ADVs, close to 34 million contracts. So, look, I think that, you mentioned a number of challenges that the industry has focused this past year. And, I think it sheds great light onto, how our industry has been able to adapt and really lean on, positive advancements in the space, that I think is going to help our, industry continue to grow and will support volumes on a going forward basis.
So you touched on multiple really important points there. I want to dive in particularly on the retail topic, which has obviously been paramount to many of our minds for the last I was going to say since the pandemic, but really the retail surge has taken on new highs just in 2021, right? So Pat, maybe we'll go to you on this, and I'll just stage it up a bit more. So retail volumes obviously have surged. Online brokers reporting massive new levels of accounts, even continuing to grow at very, very high rates. Payment for order flow was briefly a hot topic on news outlets not named John Lothian. So that was a little bit interesting. I had friends and family asking me, like, what is this payment for order flow thing? And what's going on there? Similarly, stealing another stat from Henry's presentation yesterday, which we track with a lot of interest at my firm as well. Concentration by symbol is down quite a bit. I think Henry said the top 100 names used to see 80% of the volume. Now it's more like 70%. The top 30 names, I just happened to look at the numbers, were about 40% even late last year of the volume. Now we're only about 30% in February, inching up a bit since then. So Pat, as an exchange operator, what do you see as the future of this retail-driven volume trend? You talk to a lot of the firms that source this flow and that handle it and consolidate it. What do you think the future holds for that massively important slice of volume?
Be, around the pool, having cocktails around the cabana, right? I think everyone's asking the same question, right? If or when the retail trading will subside, based upon the data that we've seen so far this year, I think it makes sense. There's a reasonable assumption that, the current uptrend in retail should continue, mainly because the themes that existed in 2020 are still present, right? I think the panels yesterday and today did an incredible job highlighting the various attributes that are associated with the current style of retail trading that we're currently seeing, right? Just to echo off of what you're saying before about Henry stats, right? The single lot trades, which have doubled in market share, from 4% to 8% over last year. The volume explosion is broad based, which indicates there's momentum trading. Buying short dated out of the money call options remains tremendously popular in 2021 so far. Lottery ticket trades, they have the longest odds statistically, but they continue to work as the markets continue to rise, right? So it's kind of like a self-fulfilling where the wheel keeps going and the strategy keeps working, right? So it's keeping those trades alive. There's been a record number of new customers joining the retail brokers. Yesterday, some of the retail brokers are reporting they've observed over 100% volume growth, which is astounding, right? So I think the conditions moving forward through 2021 seems to follow the current trend. We really have the same ingredients for the recipe here, right? Like there's zero barrier to entry for retail traders as commissions remain at zero. Access to mobile education and trading, it's only going to expand. I think over, Chris Larkin mentioned over 70% of their trades are executed on a mobile device, right? So does that turn into 90% over the year, right? It's just, there's a tremendous amount of customers, new customers that are accessing the market, right? Many folks will adopt a hybrid work model. Stimulus checks and high personal savings should also contribute to additional retail volume growth. I think additionally, we should expect that the existing, social media platforms will continue to accelerate that growth. The web traffic of the major brokers continues to move higher. They're setting records in terms of, daily web traffic, which signals that retail traders are trading more often. I think finally the economic backdrop is its position for retail trading, meaning, growth historically has been a key driver of retail trading participation. The economic data suggests that there's an abundance of household cash, which should continue to fuel the growth. Also, the short-dated interest rates are likely to remain at or near zero for several years, which means that retail trading is more likely as those investors have to reallocate funds to risk markets or asset markets that have a greater return potential. So I think all that combined, I think that we should expect to see the same trends that we're witnessing.
Yeah, makes sense. On the order size point, of course, important to note that on a notional adjusted basis, a one lot now is worth what a 3 lot was not that long ago, probably. So,
right.
Sometimes those order sizes are shrinking, but the notional isn't necessarily growing as fast. Eric, let's go to you. Same topic, and also your business now. You're looking at order handling as well as market making, liquidity provision. What are your thoughts on this retail trend and what the prospects are for the future?
Yeah, so Patrick just gave a great summary of the sort of macro trends that I think are going to support more additional options trading over time. But to, I guess, be a little more anecdotal, I'm sure that a lot of people who are watching this have had a very different experience in the last year, say, of having conversations with their friends and relatives and acquaintances who are not option specialists. And there's a very new experience of trying to explain your job to people in that everyone knows what options are now. So, to go back to what David was saying about volume trends over time, I think we're definitely going to see some ebbs, coming across the summer if we don't see the level of excitement in individual equity names that we saw in Q1. To be extremely anecdotal, just, friends of mine, especially younger people who are more engaged in like looking at a lot of financial TikTok videos, their attention has, gone in multiple directions recently. So people who are very focused on GameStop in a couple months ago are a lot more Moon or whatever. But I think that those people have a fundamental understanding of what options are, and people in society have a fundamental understanding of what options are in a way that they just haven't historically. And that core knowledge base is going to, set up with the macro factors that Patrick was talking about, I think, to create a lot of growth in the industry over time. So I think we're not going to put the genie back in the bottle about sort of ignorance of the concept of options. But, you're going to see ebbs and flows of overall volume going forward.
Yeah, I mean, I'll throw one thing in there.
No, go ahead, Steve. Sorry.
I was just going to say one thing. I think what'll be really interesting to see is, should the market environment start to change? Should we start to see the market kind of, stagnate and operate in a flat environment, or even, trend down here? Will the retail traders have, the additional, strategies to deploy in a different market regime? I think that'll be really telling if and when we see the market behavior start to change.
I think it's also a good point, right? It's like we have this new class of investor, right? And right now it's kind of like a single strategy that they're doing. But as they start to educate these different tools and resources that the online brokers are providing, hopefully that transcends into additional transactions, specifically spreads, right? I think, that could dramatically broaden as they start to get experience and they build their portfolios. I think they're going to branch out and start trading spreads, which would be, another a tailwind for the industry.
So let's pivot slightly, but not that much, and focus on the other side of the trade, which we're all very interested in, but doesn't always get the right level of attention in the popular financial press, which is the market making side. So, Eric, in our pre-call, you were talking about the fact that more firms appear to be stepping up in the equity options market making space. I would, just as a personal point and aside from my current role, say that feels like good news. It's a departure from a trend that a lot of us, certainly I was talking about quite a bit some years ago as a potential concern, which is consolidation of market makers as a risk to our industry. And what's I think often well known to this group, but often not appreciated, is what's bad for market makers means when market structure or when developments or when volumes are bad generally for market makers, what that tends to mean is there are, of course, fewer market makers because it's a competitive business. To the extent that there is and that drop off in long run competition means that ultimately customers typically get a worse price because market makers, of course, all compete for those customer orders. So Eric, getting back to what you talked about in our pre-call, do you expect that we will be seeing in 22 a more competitive market making segment in the OCC cleared options world as more shops ramp up? And what do you think that might look like, and what impact would that have for your business or for the retail investor?
Well, I think there's a couple different stories going on there right now. So, it was interesting a little earlier this morning hearing Paul Giganti sort of echo the concern that we've heard a long time about the lack of new entry into market making. And I think if you look at it on a broad scope, that is true. I share the same concerns with him about cost and the barriers to entry in the industry. And I don't think you're likely to see entirely new entrants. But at the same time, among the firms that we have heard of and who have been trading for a long time, I think you're seeing a lot of additional interest in particularly the multi-list equity option space. So since we had that conversation, I pulled some data and just based on Simplex's counterparties. And we've definitely seen a significant increase in the footprint of several large New York firms that, historically have not been big options participants, just trading a lot more names and more volume that we happen to run into. And I haven't seen it in the data quite so much, but I have also heard a lot of rumblings from Chicago firms who have historically been more focused on index options trading than multi-list options trading about their interest in expanding into the space. So this big proliferation of retail volume, I think, has created so much attention, not from just the market making community, but also Dave Silver talked yesterday about the additional institutional interest from new players that they're seeing. So I do think that more of these firms are going to get involved in multi-list equity options trading, and I think it will lead to a more competitive market. Ultimately, Simplex has recently expanded into the wholesale payment for order flow world. I wouldn't be surprised to see additional entrants in that world if some of these other firms that have a footprint like that in other products were to be interested in doing it in options. So it's hard to say what that will mean for the landscape, but I think that more competition, like you said, Steve, is going to ultimately benefit the end users of the product, and we'll see more competitive markets than we've seen historically.
Great. Yeah. So sort of a related point and broadening on Eric, your comment about entering into the customer order handling business. So all three of your firms have customers, which means that you will have insight into market trends based on data that you're able to see from your own customers that many of the rest of us may lack. So I know there are a lot of interesting things happening more broadly in the equities markets and equity derivative space. There's talk about more defined type of payout exchange traded products becoming interesting, maybe being structured around options, maybe leading to growth in options volume, perhaps as a substitute for much more expensive types of defined payout structured products that have existed historically. There was a lot of talk about a surge in SPAC trading over the course of the last year from my friends at the stock exchanges. Of course, the meme stops. That's good. I like that. That was like a little Freudian slip, or meme stop. The meme stocks continue to be pretty interesting. So, David, starting maybe with you, looking at the activity that you see from your customers or what you hear your customers demanding, what new and surprising trends do you see? And what do you expect to see, either as it pertains to these sorts of new products or other things, moving into the next year that we may find interesting or of note?
Yeah, sure. And predominantly, we deal with a lot of institutional clients. We handle some retail order flow as well. But I'd say that generally speaking, a lot of clients that we talk with have become much more comfortable with leveraging, more sophisticated electronic execution tools and workflows. And part of it was, obviously this past year, in an all electronic world, they were kind of forced to do that. And I think really what happened there is that, a number of participants and routing brokers, really drove some more innovative tools, to the algorithmic execution tools that people had access to, in the single leg space, the complex space. So, I think, along with the, enhanced volatility tools, I think there's a much more significant demand for order types in that capacity. So I guess a few more, specific examples and what we've seen. There's a bit of I'd say, an evolution in terms of, historic high touch liquidity provision. We're seeing the usage of electronic tools to augment that as well. Leveraging price discovery tools, to provide automated price discovery, additional, liquidity augmentation, somewhat combined with some of the traditional upstairs, firm facilitation activity, that's historically been dominated, by the upstairs, dealer market. So, I think we're seeing some hybrid solutions, from clients that they're looking to leverage. We're seeing a lot of clients that are using systematic hedging strategies within their portfolios, get smarter about the way that they implement those systematic hedging, strategies, using more time weight-based algos to really try to improve execution alpha. I'd say there's a bigger focus there. You mentioned a little about some of the structured notes. Clearly, we're seeing a lot of that flow continue to migrate to the listed space, which I think is great. And I think it's a big ringing endorsement on how well the listed space has performed over the last 18 to 24 months. And in that space, we definitely see those users look to leverage a lot of more electronic volatility-based tools. I'd just say one last thing, kind of some trends that we continue to see. We've talked about cost. We've talked about barriers to entry. I'd say that we've seen a lot of users continue to get more and more comfortable, with outsourcing a lot of options technology, across a larger, user base, because of the increased cost, because of the complexities, the market structure. I think that we've seen that if you, give customers the ability to leverage certain pieces of infrastructure, but give them the ability to kind of customize and tailor, what they need. There's been a lot of, emphasis to that being a differentiator.
Great. Pat, what about you from the exchange side? Anything new or exciting you're seeing in terms of client demand or interest in new products you guys are cooking up?
Just kind of to echo what David was saying, right? So we've had a ton of interest and really some new participants reaching out on how to utilize specifically, on the institutional side. There's some businesses that are growing there and how, they're interested in our electronic crossing mechanisms and our high touch model. So I think the important theme here is that, the usability of options is definitely expanded, and, all the recent activity, is really a highlight of the industry and of how transparent it really is, and how people are using the options to diversify their portfolios, and so we're really starting to see that trickle down into our environment. But of course, in terms of new product development, I would say that anything that is taking something from OTC, potentially utilizing the infrastructure and usability of listed options, I think that would be great for the industry. Especially when we think about eventually, we're competing against crypto to a certain degree as well as an asset type, right? So perhaps maybe there's an equity-like product that gains exposure there that ultimately makes its way down to the listed options world.
Yeah, I actually love the last point that you said. I think very often when we talk about trying to win customers or the category of new products in the option space, what it comes down to is everybody would love to have the next VIX. Which of course would be great. New and exciting index products and index derivatives are awesome when they succeed. But viewing our business as a better, more liquid, more transparent, and cheaper alternative to things that are happening in the OTC space, I think is also really, really important. And making that pitch that we have transparency, we have fungibility, we have low cost. We have low friction, we we hopefully have lower liquidity premiums in a lot of cases, not all the time, but in a lot of cases. So exit costs are lower than a lot of other ways to get market exposure. I think that's a really compelling value prop for all of us. So thanks for bringing up that point. Okay, so we've talked a lot about trends and volume, who's using the markets and what they want. Let's talk about how to ensure that they get it. So talking about market structure, a lot of innovations have been tried. One of the wonderful things, many obviously very, very non-wonderful things about what's happened globally over the last year and change, but one positive outcome, particularly as it pertains to our business, has been there's been an incredibly rapid pace of innovation, and sometimes forced innovation is the best kind. I mean, I think, my friends at SIBO, if somebody had told them you're going to, come up with a plan and close the floor and take SPX all electronic and you're going to do it in 3 weeks or whatever it took them a year ago or a year before that happened, they would have said there's no way, that's impossible. And they did it. They did a great job. And all exchanges have had to adapt in similar ways to varying degrees, as have, all of us basically who used to work in offices. So a lot of innovation at a very, very high speed. Some of those have had longstanding effects. I would probably argue that floor volumes don't appear to be where one would expect them to be now on an opportunity adjusted basis, although hard to run the counterfactual. Certainly lowers the percent of overall markets, but retail's also picked up, so that makes those percentages a bit distorted. We've got customer auctions now in SPX, as I mentioned. There's been this high-level and Washington-level market structure conversation about whether there should be, banning payment for order flow, and sort of headlines like that have come up in the press. Rule changes in the mix as always. Henry made a point actually about the proliferation of expirations. I think he said, I think I heard right, he said there were 31 expirations in SPY. I counted 37 this morning. Doesn't matter. There might be 6 new ones. It wouldn't surprise me. But there are a lot. So anyway, the market structure landscape continues to evolve. Does today's options investor, and I'm going to start, Eric, with you. Does today's options investor demand a different experience than a few years ago? And I'm sure the answer to that is yes, to some degree, although I don't want to front run you. What changes would you then like to see to market structure in order to improve that investor experience, get them to keep coming back again and using our product?
So, I mean, that's quite the broad question there, Steve. But yeah, like certainly the options users are more demanding in a lot of ways than they have been historically. I think that when you talk about market structure and stuff like banning PFOF or the focus on that, I just want to echo the comments of many people so far throughout this conference, JJ, Paul on the previous panel, just about how retail investors really are getting an unbelievably positive experience, right? Self-directed retail investors are probably existing in the best possible world that they could be in. I don't think there are no trade-offs there. Certainly, PFOF and particularly the existence of price improvement auctions, I think, cause a trade-off in market quality in terms of what ends up being displayed on the screens versus what's available in non-displayed liquidity, let's say. And I think that participants should be honest about that trade-off and the fact that it exists. But, at the same time, I think that you're seeing so much innovation to meet the needs of these institutional investors from firms like Dave's or our colleagues at Matrix or various other people who are providing routing solutions to, help institutional investors compete in that landscape. And I really think that when you talk about market structure changes, that's where the focus should be. There's a lot of opportunity for routing brokers to provide good service to their clients and to distinguish themselves with superior service and order protections and results. And I think that the biggest thing is just allowing the space for the participants to continue to innovate and not stifle that with too many rules changes or regulations that are going to get in the way of people competing effectively.
Nice. Pat or David, you guys want to jump in?
Yeah, sure. I mean, and I guess I would just say that I think we've done an awful lot right here, and I think the results over the last 12 to 24 months speak to that. That being said, in terms of any market structure changes, obviously this past year with tremendous volatility, you do see some issues around handling certain orders when you have errors, the obvious error rule. I feel like we've talked about these things for a number of times, but just to get some consistency there. I think at the end of the day, if there's consistency across the exchange landscape, that makes routing providers, the end clients, the liquidity providers, those are all important counterparts to the ecosystem. To have some consistency, I think that would be would serve us all well going forward.
Yeah, it's like you need to continue to foster the liquidity, get those screens lit, attract that retail order flow. Although, a high percentage of that flow is immediately, if it is marketable, it is exposed and shown to a price per proven auction to where there's a high level of competition. So I think the experience is it's great to be a customer right now, right? So anything we could do to continue that as well. But in terms of like market structure itself, I think we have to be careful of also the cost of the industry, specifically, for market makers providing liquidity, the strike issue. I think we're on a right track here for curtailment, and it's a double-edged sword. You want to add the strikes that trade, and you don't want to list random strikes that have no potential to trade, right? So it's a delicate balance to ensure that we're providing a product out there to the marketplace that can attract the right amount of liquidity and trading interest.
Yeah, I think that's a really good point. The strike proliferation one is tricky. I'm certainly happy with the path that the industry appears to be on there, and the exchanges working constructively together to try to take appropriate steps. But it's also hard, right? Because you don't know, and I certainly know this from lives I've had in the past. You want to consolidate liquidity, and there's certainly a market design benefit to consolidating liquidity at common execution points to reduce the problem of the lack of double coincidence of simultaneous wants, right? Yeah. To encourage buyers and sellers to trade the same thing. The flip side is you don't really want to say no to a customer either. And they're like, I really need this, Jan 23rd, 76 and a eighth strike. And, like there's a really good reason that they want that strike. They might be the only ones who want it, but they have a really good reason. And to some degree, as a market operator, you need to respect that. Great. So we just have a couple of minutes left. I'm quickly interested in knowing. So we've talked about the challenges of operating during a pandemic. When, to the extent that you're not already, when do each of you guys expect that you'll be back in the office or have your teams back in the office? Eric, why don't we start with you?
So I think that it's been an amazing experience through this to see how everyone was so able to adapt to working remotely, and almost everyone at Simplex was doing it, as I'm sure most people were. But I think that we definitely are eager to get back, and hopefully, I'm hoping to have our whole staff back by June 1st.
Awesome, Pat.
I would say, first of all, I couldn't be happier with our teams here. The way that we're able to adapt to the environment and the industry itself, right? I mean, the industry really proved itself. The infrastructure held up, from touch point, from originating the trade at the retail broker all the way to back, through the matching engines, the market data processes, and then ultimately the OCC and risk management and the clearing firms. The entire industry should really be proud of what we've accomplished. In terms of Box specifically, I think we're a bit unique. Our teams have been together. We've developed relationships for several years. So we really had that backbone that allowed us to operate remotely. So it was kind of an easy transition for us. I don't think we're going to necessarily draw a line in the sand to say on this date we're going to go back in. I do see, the office is open. There are people that are present on a daily basis. It's not 100%. So I think in reality it's probably going to be a hybrid model going forward, and we'll have to adapt or adjust as necessary.
How about you, David?
Yeah, no, I'd echo some of the same comments, but I'd say, at our firm at Dash, I think a lot of people have enjoyed the work-life balance and working at home, and clearly, in this last 12 months, with the conditions that we've all dealt with, I think everybody's teams have done really well, and we're really proud of our people, and I think in terms of when we go back to the office, we really haven't drawn a line in the sand. I think we'll kind of evaluate the situation, make sure that our staff and our employees, everybody's comfortable, and we'll return, people back to the office, when we think it's the right time. So no time yet, and it's kind of TBD at this point.
Yeah, I'd like to just underscore a strong agreement. I think the industry as a whole has handled this remarkably well. From our standpoint, by the way, because I wouldn't want to dodge my own question, we're still kind of trying to figure it out. I think we've had trading firms that I've worked with at CTC, trading groups, at CTC, who I think there's no doubt function better in person when you can shout across the monitor at the other guy and say, here's what I'm seeing, here's the flow. Here, let me show you my screen, get over here. No, this is how you do it. We have other trading groups that, frankly, I think function much better in a remote environment where if you've got 15 people, traders, developers, and quants collaborating closely, and some of them might be in London and some of them might be, in Hong Kong. Although, frankly, even aside from that angle, having 15 people in constant direct communication at the appropriate level of specificity and with the appropriate number of interruptions in the office, in some respects, can be harder than if everyone's just sitting in a Zoom room. And you can just kind of know, like, I'm going to unmute when I have something to say. Everyone's in constant communication. I can share my screen when I need to. So it's just been interesting seeing how that dynamic works differently with different teams. And we're definitely still taking very seriously the exercise of figuring out how we want that to work long term. Great. Great discussion, guys. Thank you very much. We are just out of time. So I want to thank OCC, OIC, and the conference, as always, for the opportunity to participate. Great success for a remote event once again. And thanks to my excellent panel of legends in the options industry for making it a good discussion this morning. Appreciate it, guys. We'll see you soon.
Pleasure. See you.
Thank you, everyone.
Thanks, everybody.
Thank you, Steve, for moderating our market outlook. What a perfect end to this year's conference. As a reminder, all of our engaging sessions and panel discussions will be available for viewing after the conference for 30 days via the Pathable platform. Within the next 48 hours, these sessions can be found on the Agenda tab of the website. I'm Glenn Thayer, and before we sign off, let's hear from OCC's Denise Kanabjian with some final thoughts and to close us out. Denise?
Thanks, Glenn. Well, we made it. We've reached the end of our first ever virtual options industry conference. From yesterday's kickoff with the State of the Industry session to today's final panel with their outlook for what's ahead, I hope you have found the sessions educational and entertaining. I know I have. As we said when we began, a lot has happened since we gathered in person in 2019, and it made for some fascinating discussions this week. With all hope and optimism for what the rest of the year may bring, we are busy planning for a resumed in-person conference in 2022. Be on the lookout for more information regarding next year's conference, and please take a moment to provide us with feedback on this year's event. You'll all receive a survey from us, and we really do need your feedback to help us as we continue to plan and shape future conferences. Once again, there are so many people who made this experience possible. Thanks again to our conference team, especially Jen Hopkins and Tricia Pearl, who were the backbone of our planning efforts. Thank you to our conference sponsors. As with our in-person conferences, your support guarantees that we can offer engaging experiences for our participants. Thank you to all our speakers and panelists. Your experience and insight are what makes the Options Industry Conference the signature event of the year. But most of all, thanks to you, our industry colleagues. We appreciate you spending 2 days with us virtually, and we hope to see you in person next year. With that, I officially close out the 2021 Virtual Options Industry Conference. Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.